What's taking place in the market right now? There are so many changes that are taking place in the commercial real estate space. And, who we listen to, that's going to impact our perspective and how we invest. And that's why it's really important that we are mindful of where are we getting our information from. I'm so excited to have Reed on the show today because in this episode, we are actually going to be talking about the market conditions, what's impacting them, what's affecting them, what does that look like in the future, what are better ways of investing at this time. We go down the rabbit hole in a very substantial way. And we also talk about, hey, what should our passive investors or limited partners be looking for before they are stepping into their next deal during this period of time? And know you're going to gain and grow so much through this time with Reed. It's fun, it's interesting, and it is one of those episodes where you're like, just buckle up and you're going to have a great time. See you on the other side.
Hello, conscious investor, and welcome back. I'm your host, Julie Hawley. For over 4 years, I've paired my background in real estate investing, education, and coaching to create powerful content for you each week. This podcast is where we take a holistic approach to investing by focusing on 3 ingredients to a life of personal freedom: health, mindset, and wealth. We'll talk about everything from passive investing through syndication and how to use your retirement accounts to boost your investing, to mineral balancing and gut-brain health, and into topics that cultivate your inner strength and resilience so you can thrive regardless of any of life's current events. And yes, those are all episodes currently available and linked in the show notes below. Join me each Monday for a mindset episode and later in the week for an interview with expert investors and health professionals so that you can experience your greatest health, strongest mindset, and build the wisest wealth.
Reed, it is awesome to see you, and I'm so excited to have you here on the Conscious Investor Podcast.
Julie, it's absolute pleasure to reconnect. I can't believe I didn't even realize you had a podcast, and now we've got a podcast. We've got to do a podcast swap, so we've got to get you on mine as well.
Oh, well, let's make that happen. That'd be a lot of fun. Reed, I love starting out with the question and conscious investor. You know what that question is. Who are you and what do you do?
Such a deep question to start with. Who am I? So I run a multifamily real estate investment company called RSM Property Group. I'm originally from Australia, moved out here in 2012, chasing a girl. She became my wife. We now have a beautiful little family. Been chasing the American dream. I moved here not knowing that I would be in the multifamily space today. My sort of shtick is that I try to talk to people about, if I can do it from moving halfway across the world, then so can you. Today we have had control in total in the portfolio, about $800 million of assets. We've obviously bought and sold a lot of those, been very successful in that space and looking to evolve into the future into other asset classes as we grow and develop and, get a bigger team. So, that's a little bit about who we are. And I always like to say I'm a down-to-earth guy. If you see me in the street, you can come up and ask me any questions about real estate, and I'm more than happy to give you some advice and how to get started.
In conscious investor, legit. So as you're at conferences, you might bump into Reed, you might bump into at an airport or wherever. You might bump into him for real. Go and talk to him. He's truly a down-to-earth person. And I really value that about you, because honestly, sometimes you can see I had seen you around in the multifamily space for so long, and you're always on the stage and you're always talking. I'm like, oh man, he's like this thing. Like, I don't think I should go bug him. And I like bugging people, but I'm like, I better not bug him. He's super smart. And he knows. And it was like just getting to know you last year after Dealmaker Lives, it was like, oh my gosh, you are so down to earth. And that's why I'm like, Reed has to come on the podcast.
I think my parents always brought me up to keep your 2 feet firmly on the ground. It's there's no success is created without other people's help and asking questions and bugging people at conferences. So I was once that person, and I'm still an avid learner today, right? I'm still curious about everything. So never stop being curious, as they say.
Never, ever. One thing that I was hoping to talk with you about today, which conscious investor, I have been working to vet conversations, and to just really know who's on the show, what voices are being amplified, because whatever you're listening to is going to influence you. And this is like, I deeply respect and value your insights, when it comes to the market, to market trends, and to what is taking place, not just real time, but you seem to have this knack at connecting events. That's a gift. And so I was wondering if we could have a conversation and start the conversation with what's going on with the market.
Sure. And I will preface, I'm not an economist. I get my information from other very smarter people than I, and I try to just break it down and use it in my everyday investing life. And I think that's the purpose of hearing people's opinions, because everyone has one, right? And then you as the listeners, or your listeners, can sort of take that on board, mix it into the soup, and then create an opinion from that to help them move forward and whatever. So, let's just start where we've come from, right? We have seen in the last probably decade, since the great financial crisis, looking back, probably one of the most biggest bull runs in history, particularly in the commercial real estate space, particularly in multifamily. And some would say it's been euphoric run up, and we're talking about people getting started after 2012, 2013, and then you heard people talking about, well, it's going to pop in 15 and 16, and then talking about, well, in 17, 18, it's definitely going to pop now, and 19, 20, it's like it's definitely going to pop now. So then we had COVID, so like it was this constant talk around maturities, and the bubble's going to pop, and there's too many people, and it's overheated, and I think at the end of the day, you've got to take a step back and also understand that there's been a big shift in how people have viewed alternative assets. There's also been a bigger shift in the way people market to investors, access to information. So and I'm talking about specifically the Jobs Act in 2012, allowed people to go and solicit deals online. And so that created a whole thing of the crowdfunding world. But it also created information age where we could get access to being smarter with our own money, right? And I think we're definitely in the age of fitness, entrepreneurialism, and is being smarter with your own money. And that has come from really the ability to share, investing tips and tricks from that Jobs Act and advertise directly. So that's how it's been a big, a whole bunch of things that have gone on. And so when we came to 2020 with COVID, we were going into some recession if you look back at the data, but the COVID then, caused everything to go up on its head. And since then, we've now been battling with inflation, and we've been battling with labor participation, and we've been battling with a very rapid increase in interest rates, which has then had an inverse effect on the assets' values across all physical assets, all commercial real estate. Multifamily has been hit quite hard. And so people are saying, well, when's a good time to invest? Like all those people that are talking about the crashes, as I mentioned earlier, like, oh, it's going to happen now, and it's not going to happen now. It's going to happen here. It's not going to happen here. It's going to happen there. Like we are in a market today where at the peak, asset prices today have come off between 25 and 30% across the nation, particularly in commercial multifamily. So you want to know a time to start investing, right? A good time to start investing. It is right now. A lot of people bought at the peak, saw interest rates completely rise, 500%, and then now their assets are worth less than maybe what they bought them for, particularly maybe even less than what the debt is on the property. So I'm saying to all those listeners out there, it's a really, really good time to be actively looking for deals and actively bidding on deals, because I think you're going to be buying them. If you haven't been tracking the data, I know I do. We've been tracking the data for many, many years. We can see in our specific markets that the price of assets today are about 25 or 30% lower than the peak in, say, early 2022, middle of 2022. So that in a nutshell is kind of where we're at. And we can dive into who's, the who, how, why, sort of, so to speak, of individual things in what I've just stated.
Let's step into the passive investor experience and say, all of these things are happening and all of this is taking place. And this is a culmination. And by the way, I was one of those that was calling like the market's gonna like it's time for it to correct. It's time for I was that person, in 2016, 2017, 2018. Like you've got it. This is so elongated. Like this is so weird. I was looking at some data recently and it was just showing. I'm sorry. Um that's a first. That's a first for a podcast. I apologize. Apparently I'm not on
Sure.
do not disturb. Um Amazing editors, would you please just cut that part out and we'll just start up again in just one second. Let me make sure this is on do not disturb. There we go. All right. When we're looking at what's taking place, it's interesting, and I'd love to hear your input on this just when it comes to recessions. I was looking at this graph that showed how recessions used to actually be more prominent, and like the cycle between the bull and the bear was, it was every couple years essentially, and over the last century and some, those cycles have become elongated, which made when I started looking at that, and I'm not an economist and I am playing catch up as a public school teacher, and real estate enthusiast turned full-time real estate investor some years ago. It's like I'm always trying to ingest more information to understand more. And I'm like, wow, that's a really interesting graph. And it makes so much sense when you think about how the economy has grown over time. And so the market cycles, I'm like, oh well, I guess that might make some sense.
Yeah, yeah. So in terms of, and I'd love to see that graph if you put it in the show notes, because I think
Yeah.
a lot of people are always looking to get their hands on some data. I think to your point where you're going with that is like the evolution of a grown-up economy, if that makes sense, rather than,
Yes.
there's so many different facets of an economy that sometimes you're too heavy on one thing. And then when that one thing breaks, it crashes everything, right? And having a more
Hmm.
resilient economy. And I think after 2008 was such a big wake-up call to so many um, so many different cities across the US. And you think of the Midwest, you think of the Smile States, the Sun Belts, where historically there've been boom and bust towns where they had to sort of, and they were going to lose talent, so they needed to do something more to to keep people around. And like, look at Austin, Texas. I think that's a prime example. And then they really had a 30, 40, 50-year vision to invest in themselves and to attract talent. And they did that through the University of Texas, and creating IP, and through that creating a job center, and through that creating business, attracting businesses through good tax incentives. So that didn't happen. Austin hasn't happened overnight. And there's a lot of other cities you can see across the US that is very similar to that may have been boom and bust and been a little bit more riding with the sort of the waves as they go up and down, because they weren't as diverse. And one of the things we talk about when you go into a market is you want to see a diversification of jobs within a market, right? So when you pick Austin, Texas, or you pick that tertiary market, you got to really look at, well, I don't want to be in North Dakota that's in a small town that's maybe really heavily reliant on mining, or maybe really, really heavily reliant now on tourism, because obviously tourism with COVID, it just completely dried up. So different things will affect different areas. And as we evolve, as the working remotely, I think you're starting to see an evening playing field, which maybe helps prolong those big periods of time between those troughs where the market does correct or fall off a cliff at some stage. Let's not take any, we will have recessions. We are already in one or approaching one. For example, and it depends on the industry, right? Like multifamily is in a recession right now. It has been for a while. The economy may not necessarily be in a recession. 2008 was a single family banking crisis recession, which obviously percolated across the world. The dot-com, back in the early 2000s was a dot-com industry issue. So each time we have a recession, it's going to look different to the last, but it also is dependent on what industry you're in. So, I personally feel like we've been in a recession in multifamily for some period of time. There's no deals, people don't want to sell, delinquencies up, rents are soft. and we've been in that for a prolonged period of time, but the greater economy may not necessarily be in that same dire situation as multi. So again, I'm going to pause, said a lot of things there for you to react to, because I think it's an interesting point you brought up between the peaks and the troughs, and the distances we have now been able to travel between those peaks and troughs.
Yeah, it's, and that's really interesting. I love that you brought, the reality is a single asset class or a single piece of the economy, like the market share, can be in a recession. It doesn't have to be. So we could even define a recession in so many different ways and say, well, great, I'd like to say tech is booming, but tech is not booming right now. So I'm like, but when we're looking at what is taking place, there are sectors that can still be thriving. That makes so much sense. I happen to grow up in California, outside in the valley beside Silicon Valley. And my family is in real estate, residential real estate. So I remember the dot-com crash. I was in middle school, and it is like etched in my brain every time I look at a market. Does this have multiple, so what's the economy based on in that market? Because
Right.
one horse and pony show is not going to work for anybody at all. So it's such a critical element in our investing.
The other thing I'll add is the economy, the global economy is all at the same starting point, right? We saw in 08.com as well was very recessions driven by innovation in certain areas. And I'm not saying 2008 was innovation, but 2008 was a US problem that percolated across the globe. Today, we were all at the, not today, but in COVID, we were all at the same starting block, right? We all had the same problem. A lot of stimulation needed to be put into the economy across multiple central banks across the globe. And that to stimulate their own economies, right? So you put money into the economy, that then drove up the cost of living, that then drove up the cost of housing, that then drove up wages. And now everyone's trying to fight to keep it under control, right? Increasing interest rates. And governments will increase interest rates in lockstep with the US dollar, particularly if they have a lot of debt in the US dollar. So that's an interesting, it's more of a data point that the entire globe is at, the entire universe is at the same exact point and dealing with the same issues all at once. It's not like the US is just dealing with it and Canada's not, or Mexico's not. It's everyone's got the same problem. And how we come out of that, how each government reacts to that, fast, slow, too fast, too slow, is going to be how people get back into normalcy again. There's also just like the geopolitical stuff that we're seeing, the wars in Ukraine, the wars, in the Gaza, in Israel, like these black swan events. COVID's a black swan event. Like I feel like in the last 5 or 6 years we've had a lot of them. I'm a little jaded, to be honest, if I'm being completely honest with you. So having some just like normalcy is probably what we're all starving for right now. And how quickly we get back there is again, I'm not an economist. Ask someone smarter than I. I don't have a crystal ball.
Okay, I wish it wouldn't. I was a mutual friend of ours, Patrick Grimes, and I were recording a podcast recently, and in that, he's like, yeah, my crystal ball's a little bit foggy. So yeah, I'm like, everybody's is. This is an interesting concept, and it's really more theoretical, but do you think that it's possible within our investing space to create our own normalcy and our own stability?
Yes. Like you have to look at what at the fundamentals, right? We're in housing. Is housing still needed today? Well, one of the things that's driving softer rents across the United States right now is the oversupply of particularly multifamily housing. You look at Phoenix, you look at Austin, you look at some of the small states. There's been a lot of product built when there was cheap money. Today, we have a lot of product coming online or in line, but now with higher interest rates, a lot of future developments have come to a halt. So what we're seeing today, like we're seeing a pullback in what we call workforce housing, which probably what we're both in. But I don't know if my workforce housing tenant is necessarily going to go and rent from the brand new property down the street. They're still going to want that affordable housing. But there's other factors that are creeping into it about why we're having rental declines, why we're increasing in vacancy, why is delinquency ticking up. All these things are happening in real time. But if you look at the fundamentals of the normalcy of it, it's like, well, people still need a shelter, and we still need to look at how much shelter is needed versus what's coming online. The other things, about where rents are, where delinquency's at, is more to do with like other forces in the market, which we can talk about, but creating that normalcy in the sense that, well, what are the fundamentals of this investment? Do I think that people are still going to need shelter in the future? Yes. So thus I'm going to invest in this over the long term. The other thing I will say, which probably a lot of people don't talk about, is, and I said euphoric earlier, we had a euphoric run. Yeah. Historically, real estate has been a medium to long-term investment. We have seen, and investors have been spoilt, not saying anything, we've seen double-digit returns in very short periods of time. I'm talking sub 3 years, where you buy a deal, you flip it, and you double people's money. I have produced that for my investors. Really proud of it. Really great banner on the wall. But in general, when you look at history, if you're doubling your money every 7 to 10 years, you're doing just fine. And people started treating this as, or commercial real estate, as a fix and flip, get in, get out. And oh my God, it's not working within 2 years. Something's wrong, right? And that's where I think, go back to your normalcy. It's like we're going back to more normal times. The last 5 to 10 years won't be the same as the next 5 to 10 years. And we're going to get in a little bit, I get asked from investors all the time, you're going to sell this in 3 years? Like, no, man, we're in this for 7 years. Like, just this is illiquid, and you need to understand. So shifting the normalcy of how investors are also thinking about real estate investing when they've seen the YouTube and the clickbaits and all that stuff online about buying this huge multifamily project and they're going to flip it and quadruple people's money. It's not historically how the game is played. And you have to understand that going in. It is a stable physical asset which has risk-adjusted returns, and you need to have that part of your portfolio strategy amongst other things that you invest in. So when it's not doing that or not producing those returns like we've seen in the last couple of years, doesn't mean there's a bad investment. It just means we're going back to more normalcy.
Okay. I'm just saying, amen, preach it, keep going on that. Because I was saying the same thing about people being so spoiled, it's like, this isn't normal. And I'm glad that people were super successful, during that window of time. That was a powerful window of opportunity. And no one should miss this next window of opportunity. Because a game has shifted doesn't mean it's not a powerful window of opportunity. Correct. It just means, okay, the game has shifted. So, are there some new rules, some new players? Like, what's going on the field? Because I can still be very successful. It looks different, but it's still massively successful. And it's going to have that return that I'm looking for. If I'm projecting out 15 years, I'm going to land where I want to land with a mix of everything. So what would you say are some of the changes or the forces that are affecting the market that have shifted that game?
I think that the big force is that we've seen is a lot of people are treating large multifamily as trying to have their cake and eat it too, meaning they're trying to have massive amounts of cash flow and appreciation. And they're just not, coming out of 2008, I think there was wildly undervalued rents and wildly undervalued asset prices at that time. And it was not a once in a lifetime, but it was a euphoric time. I think you've seen, again, more normalcy brought to the space. You're having bigger players coming in, looking at this class saying, this is not alternative, where historically it was alternative, and it still is classed as alternative real estate, but you're having more people making the choice of where they're putting their money out of, the historically safe stocks and bonds, and having more education around where you can place your money through the Jobs Act, stuff like that. So that thing, those have shifted, right? So I think today, because you have more people competing for an asset class, the risk has reduced, which means your going in cap rates have reduced, which means there's not as much cash flow for the average big deal, but that's okay, because again, it's not about you really want a ton of cash flow. There's other plays to make it, but real estate in general has been a good storage of wealth, and that is what we are all investing in real estate for: to store our wealth, to grow our wealth, And if cash flow happens along the way, not saying it won't happen, but it might take a year or two to get there, that's okay. Where like people were again spoiled to be like back in 2013 and 14, oh wow, it's cash flowing 9% out of the gate, and I'm gonna, the cap rates, but I also bought it at an 8 cap, and now I'm selling it at a 5 cap. Well, today cap rates are probably all in and around that 5 to 6 cap rate range, and rents are around $1,000 to $1,500. Right? There wasn't as much of a discrepancy to allow the cash flow to happen on the front end and then the compression to happen on the back end to get your equity multiple. Today, it's more those margins have squeezed, but there's still a great opportunity to invest in really great deals. You just have to know where to go look and find them.
Oh my gosh, it's so important to know where to go. Like, who am I investing with? Which I'm gonna want to get to in a second, but this is just more of a fun question, right? In '08, at different points, we've seen the pendulum swing lots of different directions, and people go to extremities. And because of Enron and other just things where people's entire portfolios were just annihilated overnight, people are there's a heightened sensitivity to the stock market, and now there's this opportunity. Oh wait, I can invest in these alternative assets. Let me go ahead and step into this arena. Do you think, just this is seriously conscious investor, I'm putting Reed on the spot, just is this sheerly an opinion, right? But do you think that the pendulum has maybe even swung all the way the other direction from most people's portfolios were primarily, let's say, 90, 85, 90% public investments through, stocks and bonds, swinging now to this other end of the spectrum?
No, I don't know if it's. I think depends on what TV you're looking at, like what soap opera box you're
Yeah.
putting yourself in front of. We only talk real estate, right? So thus we only talk to people who want to be in real estate. I don't think it's. If I don't have the stats in front of me, like I do know the stock market is not a representation of the economy, because only 25% of Americans actually participate. So, you take that same analogy and apply it to real estate, I could only imagine there'll be a smaller percentage of Americans that participate as active investors in the real estate market. I don't think that, but I do think that we are going to see some pain if you bought at the wrong time and you have different types of leverage, and we can talk about the leverage on a property. And I'm seeing in today's market, investors getting hurt in the commercial real estate space, meaning their positions are being wiped out because we had, they bought in 2021 or 2022, and now you've got, debt coming due or rate caps. That's not to scare your people listening to this. This is just part of being aware of what, back to the name of the show, The Conscious Investor, about being aware of when you're buying and what market you're buying into. So, and then what, financial tools you have on a property that could add additional risk to the overall investment. But we are seeing some pain being felt, particularly in like the office space, right? Because we've had a whole pendulum shift of how people work, but we're also seeing that affect multifamily as well, which I believe, back to the fundamentals, is a really good time to buy, because we are seeing asset prices valued 20, 30% lower than what the peaks were.
Which is really critical, which makes this is a really great point and a segue into the passive investor experience. I think I was trying to go there earlier, and then I interrupted my own self with the thought. But, when we think about, I'm going to add, it's not just the leverage and what the asset is and where it is, but I will say it's critical. Who are you investing with, and who is operating this, who is representing your voice at the table in the decision making process? So let's talk about that. We both represent passive investors, and bring them in a powerful way, powerful opportunities. And so there are some teams that, there are some deals that are struggling, and conscious investor, that's across the board. There are really strong teams out there. And when insurance rates skyrocket and taxes go up in ways that aren't historically precedented, the increases in insurance rates, in the Sun Belt, it's how could you even underwrite for 30 or 50%, or, oh, insurance isn't even being offered in this area? Like, there's no underwriting precedent for that. So I want to give some leash and some margin for, there are some great operators that they couldn't even predict that is a black swan
100%
for sure.
Yep.
So, but aside from that, what would you say at this time, passive investors should be asking sponsors,
Oh,
asking the team?
very good question. I think what type of debt you have on your property is making or breaking deals right now. Short-term bridge debt is a bit. I've got one deal that I wish I hadn't done short-term bridge debt on. Right, we've done 25 deals to date. We've got one that's given me sleepless nights, and that was the function of the time, right, where interest rates were a lot lower. They're less than, if the Fed rate was less than 1%. Back to your point about insurance rates. At the time, we bought, a rate cap that hedges investment, the interest rate on a particular loan, and we didn't think it would go to 5% Fed rate, right? Like there's all these things that you make a bet on, but looking back, would I have the same problem on that deal if I had fixed rate debt? No. So it's a function of the debt you get on it. So you asked the question, what do you need to ask? Like, what debt do you have on this property? What are you getting? What's the leverage? Is it floating rate? And you could argue we're at the peak right now and we're going to come down, but you needed to know we've got investors who didn't ask those questions maybe back 2, 3, 4 years ago, and now are coming to like, well, hey, there's capital calls and all that sort of stuff because we've got a certain financial tool on a property that is making it not great for investors. So first one is I understand that the debt, fixed rate debt is what you should be getting on a property right now. And then understanding the leverage. You do not want to be too over-levered. Over-levered means anything above 75%, I think, is probably over-leveraged. I think 70% lower is really what you want. And that's on price the loan to purchase price, not the loan to cost, the loan to purchase price. You having enough, skin in the game there is really, really important around how the business plan will play out. The other thing is rental growth. What are you assuming for rental growth in the next year or two? I think you could be safe to say that rental growth is probably flat or slightly negative depending on where you're investing. So understanding debt, leverage, and rental growth are 3 major things that can really impact the success of a business.
Okay, these are things that I speak the same language, and again, scarred from what happened in the '08 debacle, in real estate. Granted, I always was accustomed to fixed rate debt and liked that, but I saw what happened and how it just destroyed homeowners because they had these variable interest rate debts and it was great. And when I transitioned into multifamily, that was something we kind of carry our scars tell a story, right? And it's like, no, I've seen things. Like, give me some fixed rate debt. Like, so that's really important. Would you say also, this is fun. How do you look at expenses now? Because
Yeah,
it's
look,
really interesting when we look at the fluctuations that we've seen that have been surprising.
yes. Now, expenses are sticky, right? Particularly
Mhm.
payroll, right? I remember when I first started getting involved in multifamily in Texas back in 2012, 2013, 2014, the average payroll would probably be around $1,000 to $1,200 per unit per year. That same payroll today would be around $1,600, $1,700. So, if you're using third-party property management across most major states, you'd probably be paying similar pricing, right? My stuff in Arizona is very similar pricing to my stuff in Texas, very similar pricing to my stuff in the Carolinas. So you start to see trends. So back to the pricing and in OPEX, operational expenses is what it stands for, is that if you're doing enough deals consistently, when I say doing, but looking at enough deals consistently, you will start to see the shift in real time. If you're talking to your property manager and saying, hey, I'm looking at this deal, can you send me, I've got a thought of what I think this is going to operate at, can you send me your expenses? And seeing that uptick has been real and happen in real time. The same goes for when you're acquiring assets. If you're not keeping a sort of a check on how assets are pricing in real time, waiting for it to come out on CoStar or RealPage might be too late. So
Right.
having your own process in-house, which is what we do at RSM Property Group, is like we underwrite a lot of deals. Like last year, we underwrote 120 deals. We toured 45 of them. We offered on, I think, 40 of them. We won 2. So, you have to look at that. And that was across 5 different MSAs. So we're keeping that data. And we saw in real time, as the Fed was raising interest rates, the entry cap rate on certain markets and certain vintage asset classes was starting to increase in lockstep. For example, a 1980s asset was starting to trade in the high fives, mid to high fives today, where that would have traded for probably low fours back in the day when the interest rates were low. Similar to newer vintage product. Now we're seeing newer vintage product probably in that low fives, high four cap rate range versus an 80s product or 70s product, which is now in that high fives, low six range. And it depends on where you are in the country, obviously depends on what market you're investing in. But those trends that you start to see come from doing the work in real time and underwriting deals consistently, even when there's not a lot of deals to underwrite. So keeping your, and that goes the same with expenses. That naturally will come to you as you start looking at more deals and more expenses. But it is sticky, and I don't know, again, I'm not an economist, but I don't know if you're going to see a drastic change in insurance cost or a drastic change in your personnel costs on site. So I remember when we first got started, you could get a porter on site for $15 an hour. A same good porter was probably cost you $25 an hour today. So it's just a change in thus back to fundamentals, rents are going to have to go up, right? Because the cost of where people live, they've got more money in their pocket, they're going to, rent's going to go up. So that hedges us as real estate investors, but I don't see that porter payroll going from $25, $30 an hour back down to $15 an hour. It may come down a little bit, 10%, 15%, maybe low 20s, but I don't see it going way back to where it was back in 2013, 2014.
It very rarely happens. Very rarely. Even when we look at the price of gasoline, right?
Mm-hmm.
It's like it goes up, it hits these peaks, and then it comes down enough to everybody's like, oh, thank God. But it's not down to where it was before, and it doesn't go back down. It creates that new marker. And I'm not an economist, and I don't know all the proper terminology for it, but it's like I understand the concept. I'm like, we didn't get to go back down to where we were. I'm not paying 76 cents.
Right. And insurance, for example, is a great one. I used to pay $250 a door in Central Texas back in 2015. That was a really good number to pay. Today, you're probably looking at $1,000 a door on a 1980s vintage asset. So that's gone up fourfold in what, 10 years now. So that's, does it go up another tenfold in another 10 years? I don't know. So same with rent. When I first got started, the average 2-bedroom in Central Texas was about, on an 80s vintage asset, was about $850. Today, that same probably renovated is $1,400-$1,500. So everything will go. The trend there is that like when things increased in cost, so your rent. But what we've seen recently is that we've hit that ceiling, and now we're starting to come back down a little bit, but not everything's coming down at the same time. Payroll's not coming down at the same time. Insurance not coming down at the same time, but you start seeing some softening in rents, not drastic softenings that back down to $850, but you're seeing, 10% reductions from those peaks in, post-COVID. But the sort of what I'm trying to get across is that things across the board will start to rise. Things will start costing more. So, as you start looking for deals, just understand that.
Yeah, definitely understand that. This is amazing. I love this conversation so much, Reed. And I know we're coming up to our time. I'm wondering if there's anything that you're like, I really want to make sure that the conscious investor understands this before they make their next investment.
Look, I think in general, being a true investor means that you need to be investing. Doesn't mean you have to place money on the street every year, but if over the long term, you should be constantly putting money to work every single year. Mm-hmm. And over 20 years' time, you will have created a nest egg that you're going to have the peaks and troughs along the way, but you're still going in an upward trajectory. So if you bought in 2021 and your assets now low, in 5 years' time, it's going to probably be back up again. Rents are going to be even higher than what they are today. Know that you have to continue to be investing over the long term. Understand that real estate, particularly commercial real estate, is a medium to long-term investment. And you should be going in with eyes wide open. And it should be that part of your portfolio that you want to invest in because of those reasons. It's safe. It's a physical asset. You get tax benefits from it. And then you might have another part of your investment that is for the stocks and bonds and more opportunistic stuff that you may be interested in. It's about having a well-balanced portfolio, and approaching each part of that portfolio with eyes wide open, understanding what it means for you and your investment.
Mm. Boom. I love that. It's so great. You guys have some you have some opportunities on the table. And I didn't ask you if those are 506C and if we can discuss them, or I don't want to make any assumptions and I don't want to put you in a spot that will flare the SEC.
We're all 506C over this side. Yeah, look, not any one specific thing that we've got going on. We've got a debt fund going on. We're about to launch a new vertical in medical office investing. We're looking at RV park investing as well. Because there is a bit of a slowdown in the multi side in terms of just inventory. So we're being opportunistic. We've got a ground up construction build for rent deal that we're coming out of the ground here in the next couple of months. Let's close that deal. But it just gives you a flavor for, as the market shift, we as investors, we as fund managers also will shift, still being backed by real estate, but it could look and smell and look a little different. We're actively trying to hunt for deals now. We do truly think that there's great deals to be had. It's just about trying to entice investors to get back in the pool.
Yeah, just reminding investors, don't worry if you don't understand what the game is and how it's being played now. That's why we're professionals, and so we know what the new strategy is. And I love that debt funds are really powerful right now, and over the next couple of years, I mean, talk about gaining some velocity. I think that is a fantastic opportunity for investors to gain a lot of momentum in their
100%.
portfolio.
Yep.
Definitely. What is the best way? Where would you like people, if they're interested in learning more about your investments or connecting up with you because you're safe and comfortable to talk with? We established that at the beginning, right? Conscious investor.
Yeah, the easiest way is go to my personal website. That's reedgoossens.com. That's reedgoossens.com. You can also head to our company. It's rsnpropertygroup.com. Or you can search my name on Google and it'll come up. And if you're ever coming through Los Angeles, hit me up. It's info@reedgoossens.com.
Awesome. Reed, thank you so much. I appreciate your time, your expertise, and thanks for serving investors so powerfully. And conscious investor, remember that this podcast isn't just here to, fill your ears. Yes, it's here to serve you and it is to support you. But don't be a stranger. I'm not just a voice over here, nor are the guests. So make sure that you take a moment and schedule time for us to connect up, to discuss your next steps, whatever those look like. Because adventure belongs on the trail, right? Not in our investing, not in our personal life. So don't be a stranger. Until next time, cheers to your health, your mindset, and your wealth. Are you enjoying this episode? Help spread the word by sharing the episode with a friend or family member. Because really, where would any of our lives be without other people sharing great content with us? Help spread the word by sharing on your social platforms and with those you care about. And remember, tag me @HappyJulieHolly.